Welcome back, everyone, to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe, and for those of you that do and have tuned in before, thank you. Today is July 12th, 2020, and today I'm going to go over some of the things to look for in the coming week. It is earnings season. We have a couple of pretty important earnings reports coming out this week. We got Netflix, we got Goldman Sachs, we got a couple of the banks, JP Morgan, etc. Also going to go over some of the effects of COVID-19, how they still persist, and how we have a tale of two tapes, as I like to call it. We got two markets going on right now. We have the overall S&P 500, and we have the NASDAQ, which seems to be just running in some sort of parabola. For those of you that aren't familiar, you can check out this podcast on YouTube. There's a video version of this podcast. So if you are checking it out on YouTube and you just want the audio version, please feel free to check it out on my podcast channel. And if you are listening to this on the podcast and want to check out the video version, please do so on YouTube. You can check me out on social media at EveryTimeICash across all social media platforms, or at everytimeicash.com/contact. Once again, it's everytimeicash.com/contact. And then again, for those of you that don't know, my YouTube channel is at EveryTimeICash. You can check out this video version there and check out some of the old videos that have taken place as well. So I'm going to start with the difference and the bifurcation between the market itself, which is the S&P 500, and the tech market, which is what we're seeing in the NASDAQ. So in the NASDAQ last week on my YouTube channel and on last week's video, I gave a reference to a 10-year channel that the NASDAQ was residing in. I am highlighting the arrow breakout on the screen here with where it was that we broke out of this 10-year channel. And I've highlighted in blue a channel that it's been riding since early April. So since the Fed basically came out and said we have the back of the corporate bonds, this is what the NASDAQ 100 has looked like versus the S&P 500, which I'm putting on the screen currently. So the S&P 500 has had some sort of trajectory growth like the NASDAQ, but it's been kind of choppy since it peaked out in early June at the 3220 something, 3225, 3220 level. This is the level that it started to break down from in early February. So February 24th, we broke this level. And we've kind of just done some back and filling for the last month or so on the S&P, where we had a precipitous sell-off on June 11th, and then we tested and held the 200-day a couple of times and have been building support and been building a base of the moving averages since then. So it's really important to note what we've seen, because we've seen this very interesting difference in the market. We've had two markets. We've had the S&P 500, which is predominantly made up of weighted measurements, and predominantly made up of the entirety of the market and the entirety of different sectors. So basically, it's not heavy in one index. Amazon, Microsoft, Google, Facebook, and the heavyweights like that do make up a significant portion of the overall market itself. So I think they account for about 25% of the overall market. But that 25%, those 5 names or 4 names that make up 25% of the overall market, that is still 25%. We still have 75% of the marketplace made up of a plethora of different sectors, a plethora of different companies, a plethora of different industries. So unlike the NASDAQ, which the NASDAQ is tech heavy, NASDAQ 100 you see on your screen currently is made up of predominantly technology. So as it's predominantly made up of technology, the trajectory of this market is, in a way, just mirroring the trajectory of tech in general. So in the S&P 500, we have 25% accounted for by a handful of just really big tech names. And what it's been able to do is any selling pressure that we've seen in, travel stocks and consumer discretionary and the COVID related names and real estate, whatever the case may be, whatever weakness you've seen, it's been offset by this strength that we've seen from a handful of names in the tech sector. So what we've seen in the real economy, as I like to call it, so the real economy being places where I can go physically and in real life show up and buy things or try to purchase things or participate in economic activity. What we've seen there, and that slowdown that we've seen there in the last couple of months, because we've had one step forward, two steps back on reopening in different places across the country. That instance and that like sluggish action that we've been able to see in the real economy has been offset by the digital or America 2.0 economy. And that's your Amazon, your Netflix, your Twilio, your Zoom, your Teladoc, Peloton, whatever. So all these companies and all these stocks that we've had that are basically a digital platform, digital company, online, those companies have not really seen predominant disruption as of yet, because investors have been overlooking any future earnings hampering with the understanding that the Fed has the back of the market and the Fed has the back of corporate America, and they've had the back of corporate America by building a money bridge and by backing those bonds. So essentially, investors and traders alike have been flocking to companies in the NASDAQ 100 and in tech stocks in general as a safe haven, because they have growth, because they have strong balance sheets, et cetera, et cetera. So I wanted to start there and start on that front, because I think it's very important to know that what it is that you are trading and what is going on in the marketplace itself, and why the S&P 500, you have a plethora of stocks or a plethora of sectors that haven't been able to participate, but you haven't really seen any meaningful sell-off yet. That's number one. Number two, I want to point out that ever since, so let me see if I can find, so ever since January of 2018, where is it? So January 2018, we topped out here, and that is when we had the initial instance of a trade war. So since January of 2018, we've made 1, 2, 3, 4, call it 4 meaningful highs or 4 relative highs since January 2018. But for the most part, we haven't made any progress since January of 2018, and that is primarily because of a trade war. And the overall effect of the trade war has been no real meaningful growth for industrial or farming or real economic sectors. So this is important because the whole point of the trade war was to better the United States and to better the United States global positioning, and to better domestic growth, and to better the overall agricultural, industrial, construction, real growth sectors and the lifeblood of the economy, right? But as you can see on your screen, since 2018, we haven't really made any meaningful growth. We haven't really made any meaningful progress. In late last year, we had a closing of phase 1 of the trade deal. We had some sort of arbitrary handshake, some sort of arbitrary document that was signed, and we've moved past phase 1. And then we had some Fed repo action that kind of greased things, and you saw a meaningful bounce in the Dow that created all-time highs. But by and large, we don't have any real growth on the trade front, and we don't have any real trade resolution. We don't have anything really. So it's been very difficult for companies like banks, industrials, agriculture, et cetera, to show real foundational growth, because we haven't had any real trajectory on a growth front. And I bring this up because if you look at the Chinese markets, and if you look at how China has performed, China made a 5-year high 2 weeks ago. So the Shanghai and other composites made 5-year highs 2 weeks ago. And then last week on the Chinese front, the Chinese party stated that one of their main initiatives, or one of their main directives, is the importance of stock market growth for their economy. And essentially, when you saw that, you saw a serious pop across the board in Asian equities, and you saw, if you mirrored that pop with search trends, you saw how to open stock accounts in China as one of the major search trends last week. And this is really important because this has been taking place, this relative and absolute high in China has been taking place as US dollars have been fleeing China. So I credit Josh Brown for this stat because I didn't look this up. I heard him say it. But Chinese equities, so US dollars have been fleeing Chinese equities to the tune of 7% year to date, while these Chinese equities have been making relative and absolute highs. So essentially, US dollars have been leaving Chinese companies, and Chinese companies are making current and absolute highs. And I bring this up because I think that it's an important place to start. It's an interesting place to start, as you saw the K-Web, which is the China internet sector, make all-time highs last week, and you see this giant potential after a 2-year break on the K-Web. And I want to start there, and I think it's an important place to start because if you can get an idea of how the U.S. is performing on a relative basis, whether it's COVID, whether it's the markets, whether it's their own equities, whether it's the trade deal, whatever the case may be, on a relative basis, there's been some sluggishness. And if not for the overall tech sector, there would have been, and there would be, significantly more sluggishness. But the importance of this but is very important. But the United States itself and the companies in the United States themselves are primarily service-based companies, and technology has been a great facilitator for the United States as it pertains to these services. So as more and more companies become tech companies, so like Tesla last week accelerated and blew off and is a bubble and whatnot. But Tesla moving forward is on pace to have its 4th profitable quarter, which is what their investors are looking for. And that would create an opportunity to be a part of the S&P 500. And the more and more you see this out of tech companies, and the more and more you see this out of tech-related companies, the higher multiple you will be seeing in the S&P 500, and the better the overall S&P 500 should perform, despite seeing issues in real economy stocks such as travel, such as brick and mortar, such as regional banks, et cetera, et cetera. So it's really important to understand this. It's really important to understand on the front end how things move and why they're moving the way they are moving. And I'm not telling you that I understand this as well as most, and I say most because I'm sure there's a lot of people that have a significantly better understanding of trade relations and of the overall impact of these trade relations to the market. But I think it's really important to understand these things, and I think it's really important to know the differences and to know the relative and absolute performance basis of the United States and of China, so we can get an idea of what to expect moving forward and how things can perform should different outcomes take place. So with that being said, and with that rant over, I'm going to start with the Chinese K-Web China Internet ETF. And first and foremost, I'm going to start with BABA. So Alibaba been in this interesting megaphone pattern, and as you can see, we broke out of a 6-month range of a high put in 2020. If I zoom out, you see that the prior high to 2020 was in June of 2018, and that high watermark was set at 210, give or take. So I'm going to zoom back to this, I guess you can call it a megaphone, and as you can see, if BABA can just consolidate above its prior high of 230, you could and should see testing of 300, maybe more, as you see in this megaphone. The next one I want to point out is, and I'm going to just share this. So BABA. So I'm going to share this just so I can put it out there. The next one you're going to see is JD. So JD is up, I believe, over 100% year to date. It's been high and tight, up and away, ever since it broke out of this $50 level. So with JD, again, same thing, with China backing their own equities, with China kind of greasing things for themselves. I'd like to see some sort of consolidation, and then any sort of pullback to this $50 level, give or take. If I can get a 200-day moving average support as well, I'm going to look to be a potential buyer here. Next one is NetEase. This one has just been a monster. It's really difficult to trade, I've found, for me, in terms of options, but it's been, ever since it put in a low on March 18th of $267, it's been up and away, up and to the right. The next one I want to go over is EDU. EDU just recently broke out of this range. It's above this 140 high water mark level set back in February, and it looks like it's starting to consolidate. And for this one, if I can get this 5-day, here, let me highlight it for you. If I can get this 5-day moving average to just kind of catch up while this thing goes sideways, it'll set up for an opportunity to go higher. Next one is Baidu. Baidu is interesting because if I zoom out on Baidu, so let me go to weekly. If I zoom out on Baidu, Baidu set a low in 2013 at around the same level that it set here in 2020. And if you just take a look at how it performed from this 2013 low of, call it $85, and how it's performing now, it's pretty similar. So Baidu is an instance of stock that I want to look to include as potentially an investment, as it still has room for catch up, because this is one of the stocks that has not created an all-time high and is nowhere near its all-time high. So it's one of these companies that I want to look to add as its moving averages start to join, and this confluence of moving averages is going to provide pretty stellar support moving higher. But it's one of these stocks that I'm looking at as an opportunity because it hasn't made its all-time high, and it's nowhere near its all-time high, and it's cheap relative to some of its peers. Other stocks I look at are like Momo. This is a company that is breaking its downtrend and is starting to act pretty interestingly. It's starting to find support on a 5 and 50 and potentially 20-day. As a momentum trader, that's what I look for. This is some of the action that I look for a bearish to bullish reversal. Outside of that, there's 2U. I can do this one in real time for you. So it had this weird downtrend pattern it snapped out of. Now I'm looking at a potential gap to fill. Should it get to, let me do this again. So it has a gap to fill. Looks like that was resistance 1, and then you're probably going to have resistance 2 here, and then the gap to fill would start there. So if you can get a break of this $43 level, delete this. If you can get a break of this $43 level, it puts that gap in play. And then for me, what I would look for is a break of this 45 and then 48 level. And then I'm looking at a potential gap to call it 58 just to be safe. So that's one way I'd look to play that one. Outside of that, Auto Home is another one. I think this, if I remember correctly, this one is like a Carvana of China. And it's got a bearish to bullish reversal setup. So again, you've got confluence of moving averages, 5-day acting as support, should see 20-day second support, and then you could see this one really take off. Outside of that, again, I mentioned So Young last week. I'm looking at stocks like this. This one failed last week, and then I'm looking to see the 20-day and then the moving average confluence act as support. So that's essentially China. It's essentially like the Chinese watch list that I'd have on my screen. From there, I'm going to just start to go through some of the things that are going to happen moving forward, which I'm going to start with the ever-loved FANG name. So FANG Man, however you want to put it, whatever you want to say, they are almost always treated as a group and that they trade together. But if you pay attention, Apple, Microsoft, Amazon have been acting differently than, say, Facebook and Google. And I bring this up because, and I think Netflix too. Netflix, as of late, has taken off. But yeah, if I pull up Netflix, for example, it's since 2018 hasn't really gone anywhere, right? And this is relative to itself. And if I do that with Google, it hasn't gone anywhere since making a high in February of 2020. But prior to that, it had this huge sideways action for 2 years as well. And then if I pull up Facebook, same thing. Facebook makes this high, has all this bad news, goes back, hasn't gone anywhere. So it's really important to know that, like, when people talk about MAGA stocks or they talk about the FANG or FANG Man or whatever they say, it's really important to note that these things don't necessarily move together, that they are collectively owned by and large the same. But, you know, just take a look at Amazon. Amazon made a high in 2018 and really didn't go anywhere until April of 2020 this year. And it's been up and away ever since. And it's been parabolic ever since, but it really hasn't gone anywhere when you compare it to other stocks since 2018. If you look at Apple, Apple in 2018 traded at 230, broke out in October of 2019, and it created a massive run up before retesting that breakout level, and now it's going to run up again, and it's continued to run up again. If you look at Microsoft created a high in 2018, broke that high in 2019, has been pretty much by and large outperforming since it broke out of this narrow range. Let me highlight it for you. This narrow range that it set between June of 2019 and October of 2019. And when it took off in October 2019, it was up and away, retested that breakout, and then up and away again. So I bring this up again, like, it's important to know because, yeah, when you look at Facebook, for example, you look at how Facebook's performed since making a low in March, and it's like, man, it's up 40%, it's up 30%. But then when you zoom out, you're like, yeah, it's up 30%, but in 2 years, it's gone nowhere. So it's really important to note this, because should Facebook continue to outperform on a business sense, so should you see COVID actually continue to be a problem for investors and for businesses, companies like Facebook that haven't gone anywhere for 2 years, if they can outperform on a business front, they will show outperformance on a relative basis in a market front, because for 2 years they've gone sideways. For 2 years they've had pent-up demand, and they're just now starting to show aggressive outperformance on a short and intermediate basis. So I think it's really important to know this, because when you look at Netflix, and I'm guilty of this, because I had Netflix trading in this channel, and Netflix broke this channel and came back, and I didn't take Netflix when it broke out on Friday, for example, because I'm like, hey, what's the upside? Well, if I zoom out, upside's huge, because Netflix is in a 2-year consolidation and a double bottom formation, a W, whatever you want to call it, inverted head and shoulder, whatever you want to call it. Netflix is in this formation. And if I really zoom out and I show you on a weekly basis, let me reset this. If I really zoom out, Netflix has a lot of upside before it hits this channel top, where let me hit. It has a lot of room if it can continue to break out, and before it hits this channel top that has acted as resistance both in 2004 and again in 2018. So it's really important to know what it is that has been going on, what it is that's going on, and how it is that you can trade a particular name, and how it is that a particular name can perform on a relative and absolute basis. And it's important to know that just because I saw something take off for the last 2 weeks doesn't mean that it can't take off moving forward, because in the case of Netflix, for example, like I said, it's gone nowhere for 2 years. So let's say they have their earnings, and let's say their earnings are, suboptimal. It could go all the way back to this breakout point, and which is highlighted by this arrow on your screen, and this breakout point can provide another opportunity for me to go long. Or I could go back to the 50-day, and this 50-day could be pretty much a mirror of this channel that it's been in since September of last year. So it's really important to know these things. It's really important to note these things. And in the case of Netflix, should they have a massive outperformance, they've got a lot of room to the upside should investors want to continue this flood of liquidity into these stocks. And then from there, I want to highlight Google, because Google, like I said, went nowhere for a very long time. It broke out recently. It broke out in November of 2019, created some outperformance, created a top in February, went back and retested this $1,000 mark, and is now starting to create a probe of this 1,500 level, call it, give or take. And this is a huge cup and handle that it's formed, and it has significant upside momentum should investors be rewarded with a good quarter from Google. So take a look at these things on an individual basis. See how they perform versus one another. I know it's really fun to say FANG. It's really fun to say MAGA stocks. It's really fun to say FANG man. But these things don't necessarily trade in unison. And there is a potential for rotation within the group. So there is a potential for investors to say, hey, you know what? I've seen Microsoft, I've seen Apple go run for a while. Now let's move the other one, or let's move Google, let's move Netflix, whatever. And then in the case of Netflix, for example, Netflix was included in this group by Jim Cramer when he dubbed this the FANG stocks, but it doesn't necessarily have to move with them at all. So Netflix is a lot smaller than the rest of them and has a lot more potential for upside because of how much smaller it is and because of how asymmetric it is. And then Facebook, in the case of Facebook, again, smaller than Microsoft, Apple, Amazon, and Google. So it can see some sort of torque in the name should they break it out of this, what appears to be a flag, broadening megaphone, whatever you want to call it. Should it break out, you've got, like I said, you've got 2 years of pent-up aggression and a double bottom basically formed where it could just start to act a lot better than its peers, especially with all the negative news that's been in the name and with everybody assuming that advertisers are going to pull their money and not come back. So should you see that, that is a place that you could look for outsized returns, outsized potential. Outside of that, I just want to focus on some of the tech names. So for me, like Square's, this is another example. Square created a top in 2018, just recently broke out of that range, and you've seen just basically up and away, no room for entry, no room for a check back. But should you get a check back to this breakout level at 100, should you get a check back to that level, and by then should the 50-day act as support, that's an opportunity. It could present itself or it could not. Shopify is another one. Shopify has been creating some sort of tension, and then as it's shown in the past, any sort of tension creates more room to the upside. This one, again, up and away. And I'm pointing this out from a technical standpoint. I'm not talking about fundamentals. I'm not talking about the fact that Shopify trades like, I think it was 60 times sales or something like that. I'm not talking about that. I'm just talking about from a technical standpoint and from a liquidity standpoint in the marketplace. Tech seems to be a safe haven, seems to be treated as growth, seems to be a flight to quality, flight to safety, seems to be a Tina trade, seems to be just like put your money into it, see what happens kind of thing, greater fool, whatever. But for me, like I said, I'm a momentum trader. This is a name that has been unanimously respecting its 5-day and has been respecting creating some tension as it goes sideways, then creating more upside demand. Coupa is another one. Coop, up and away. Again, 20-day has been acting as support. You've got this trend. You've got this trend in the name. So, again, another one. CRM, I mentioned this one last week, just started to break out last week. It's not a stock that I trade personally. It's a to me, it's like one of those own it kind of names, but it's creating new highs and setting up for potential upside. Now is another one that I pointed out, respecting this channel top, but if it breaks out, again, want to see this top channel, I could test it. From there, I want to point out the chip names. So SOX and SMH, it doesn't really matter which one you prefer, but they're both starting to act very well, both starting to create new highs. NVIDIA was one that created a new high last week, and now it's respecting that 5-day with some momentum. AMD was a name that looked like it started to break out last week, and I want to flag this 59-60 range. Look, if that level can get taken out, you're going to see some serious FOMO chase on that one, in my opinion. Qualcomm is another one. Qualcomm has this range from 2019 till today. If it can break out above this 95 level, should test this 96 level, and then who knows, sky's the limit. Avago is another one that I like. You're starting to see confluence of moving averages, some sideways action, created a high water mark in 2019. Then again, late January 2020, should it break out, should create some chase. Light is another one that I like, starting to act very well. Broke out of this little wedge that had formed and is setting up for potential more upside. Cruise, another name, it's been in this uptrend and is forming a wedge that started in early 2020. And should it break out of that wedge, should retest the highs that it set back in early 2020. Intel has started to respect this 200-day that it hit. This is the first time that Nvidia is a higher market cap than Intel. This is the first time that Nvidia has crossed that threshold. So this possibly can set up an opportunity for Intel as it is trading cheap on a relative basis. MU Micron is another one starting to create some momentum to the upside. It has respected this uptrend. Got a confluence of 50, 200, and 100, starting to break out above all of its moving averages. This is one that I want to keep my eyes on. Western Digital, another one, kind of gone sideways, gone nowhere. It could start to see some sort of momentum to the upside should it have any sort of catalyst for upside momentum. From there, Dexcom. Dexcom is one of the outperformers in the marketplace in general, and it just keeps creating new highs. Just keeps up and to the right. Recently, it broke its high water mark from May, and it's currently resting on that 5-day and above that high. Should it continue to go sideways, should it continue to create more tension, it could create more opportunity moving forward. Outside of that, I want to highlight some of the cybersecurity names. So this is a sector that I highlighted recently. It recently made a high. It recently broke out of this range that it set between May of this year and this last week. Prior to that, it set a high in February of 2020. And then prior to that, you had high water mark in July of last year. So I point this out because Palo Alto Network is starting to press up against its highs where it set that watermark in November of last year, and prior to that set a high watermark in February of last year. So I'm looking at Palo Alto. I'm looking at, let me drag this out for you. I'm looking at this 250 level, and should it break out, I'm looking for it to potentially test its prior highs. It did have, around this time last year, it did have a headline right here. Yeah. It did have a headline of, I believe their CFO left the company. So it does have this gap that it filled, and it should go sideways. Should it break out, look for prior highs to get tested. CrowdStrike is the perennial winner in the group. In my opinion, this one is best of breed. We'll see how it performs. FireEye last week started to have some sort of call buying. It's not a thing that I really track, but it's starting to show some signs of life and could test this 200-day. Outside of that, there is CyberArk. This one, it's not a name that I particularly trade, but it is starting to act responsively and is starting to act strongly above its 200-day and all of its moving averages. This is a name that I could add to my list to keep an eye on to see if there is any outperformance moving forward, as it seems like it's broken out of this downtrend. And then should it break out even further, you're looking at 117, 125, and then a gap to fill. From there, I want to highlight opportunities in asymmetric, for asymmetric risk. So if things start to look better on a COVID front, if things start to look better on an economic front, if you start to see some sort of mean reversion, I'm looking at stocks like Macy's, which is, resting on this 50-day, and you basically have a 50 days your stop out, and then you could have a test of its 100 and then 200 days to the upside. Another one is JWN. Again, you've got this, call it $14 level as your stop out point, and then should it go higher, you have above its 20-day, you have the 50-day, and then you've got the 100, 200-day as your stop out. Outside of that, I'm looking at Restoration Hardware, which is in this huge cup and handle for the last year or so. Should it break out of this cup and handle, could create serious upside. If it gets sold, I'm looking at the 50, 100, 200 as support. If that holds, could see some quick buying and quick propping up of this name. Lowe's is another one, pressing up against highs, holding up against prior highs. Again, cup and handle, if you want to call it. You want to call it potential flag, call it a breakout, whatever. It's not important what you call it, what it is. What is important, though, is it is setting up for potentially breaking out of this range that it's been in for the last couple of weeks. Home Depot, another one, pressing up against that downtrend, set a prior high, and is holding up against that prior high that it set in February. Outside of that, I'm looking at other names that you can look at are Target. Target is holding the bottom of this wedge with the Walmart news last week and Costco having stronger same-store sales. Target could set up for an opportunity to retest the top of this wedge that it's in, which gives you about, 5%, give or take 2% to 5%. Costco, like I said last week, had great same-store sales, broke out. Now it's holding up against this prior high that it set in the name. So outside of that, I'm looking at Lulu. Lulu is holding up against its 20 and 5-day, really setting up for an opportunity to break out through its prior high that it set here recently in June. Nike is another one that I have on my list. 50-day acting as support, cup and handle, downtrend, breaks out of this downtrend, should test this prior high. And from there, I want to move to the IBB. IBB I highlighted last week. Again, it's holding up against prior highs that it's set up and to the right. There are some names I want to highlight. Illumina I highlighted last week. It did make a high, didn't really break out. So I want to pay attention to see if it could break out above this recent high that it made. I also want to pay attention to Gilead, as again, it's still riding this trend. I want to pay attention to mRNA. Gets above this 67 level, could challenge its prior highs. Amgen is consolidating nicely. Want to see this 245 level get tested and hold. Hopefully by then you have 20-day as confirmation. If you can get that, I want to look to be a buyer there. XBI, same thing. I want to see a retest possibly of this high that it broke out from. If the 50-day can act as support, I want to look to be a buyer there. Outside of that, you have Johnson & Johnson, which is not in the IBB, it's in the XLV. But Johnson & Johnson has earnings this week. Johnson & Johnson is testing this 200-day and is in a downtrend. Should it break out, could see some serious torque. Lilly is a stock that is similar to this one. Lilly, if I zoom way out, Lilly recently broke out of a 20-year range. So it broke out above this, call it 110 level. so long as that level holds, you've got 20 years of pent-up aggression in that name. I can close this one out. I don't need it. But yeah, so I'm looking at this 110, give or take, level. And this coincides with its 200 week. So any sort of sell-off back to that range, and if it can hold, that's one that I look to be a buyer of on a relative and absolute basis. Again, from there, I look for asymmetric risk. Asymmetric risk, let's go to DraftKings. If this $30 level breaks, look for the 100-day, $100 or 100-day breaks, look for 200. Any sort of breakout from this little downtrend. Any sort of breakout from this little downtrend should give you a 20-day. But if it can get back above, the 20-day, it sets up for prior highs. Outside of that, Peloton, up and away, DocuSign, up and away, Zoom, up and away, and the list goes on and on for those names. So those are names that I'm not looking for any sort of addition at these levels. These are just kind of like FOMO stocks. I'm good without them, but I am looking at what could be like the next snap, the next FOMO chase. And I'm really intrigued by Tilray, and I have been for a while. And the reason that I am is because if I look at it on a weekly basis, the 20 week has acted as really solid resistance all the way down. Any break of this 20 week, and you could see a serious chase in the name. So this is one that I'm highlighting going into this week. This is one that I'm interested in. It's one that I bought at the end of Friday, but this is one that I'm really interested in. And if I can get any sort of confirmation above this 20 week or any sort of breakout of this blue downtrend, it will really set up for asymmetric risk to the upside and really gives you a very well-defined 5 days. My stop out could get to 100, maybe even 200 day. So these are the types of trades. I left this one for last because these are the types of trades that I am looking for on a relative and absolute basis in this market moving forward. And then outside of that, like I said, Netflix and things like that have been sideways trades for 2 weeks and are cult favorites, they can break out. So outside of that, I just want to highlight a couple quick things. Goldman Sachs, Morgan Stanley, and let me just pull it up. So this is courtesy of Earnings Whispers. It's an earnings calendar. So you'll see you have Wells Fargo, Citibank, PNC, Goldman Sachs, and Ally Bank, BlackRock, and I believe JP Morgan soon will be reporting earnings. JP Morgan's on Tuesday before the bell. I missed it. So yeah, JP Morgan, Wells Fargo, Citibank, First Republic, Goldman Sachs, PNC, BNY Mellon, BlackRock, and Ally all reporting earnings this week. This could be a tailwind for the banking sector, so the XLF. And then there's the KRE, which is regionals. So for me, I bring this up because it can provide an opportunity. And in the case of JP Morgan, I owned it until late last week. I sold it on Friday because I just don't want to hold anything through the weekend. But it sets up for an opportunity to test that 100, potentially 200 day if they say anything that's not as bad as people anticipate. Bank of America is another one breaking out of this little wedge and sets up for 100, potentially 200. PNC, another one. Here's your wedge. Sets up for 20, 50, 100, 200. Goldman Sachs acting a little bit better than most of them. If we can get above this 200-day, there is a potential that Goldman Sachs can test these prior highs that it set in February at 250. Another one, this one is my favorite of the bunch, Morgan Stanley. Morgan Stanley sets up for an opportunity to test these highs that it made early in the year. But the reason that Morgan Stanley is my favorite is because if I zoom out, you've got this wedge, this downtrend that it could really challenge. And then if it could break out above that, it could really set up for more upside. Another reason I like Morgan Stanley is because they have international exposure on a greater basis than they do domestic. And EEM and China have been kind of acting a little bit better than the U.S. domestically on a relative basis. So outside of that, I'm just going to go over Tesla because everybody's a fan of Tesla. Everybody wants to talk about Tesla. Everyone wants to know what's going to happen with Tesla. This is a bubble. There's no other way to say it. Tesla's a bubble. It's a cult stock. It's trading on FOMO. It's trading on Fugazi. It's trading on hope. It's trading on hopium. It's trading on anything but reality. Tesla is a bubble. I don't know when that bubble will pop. When these bubbles pop, they are violent to the downside. I don't look to short this name anything greater than just shorting on a short-term basis. So there are opportunities that it sets up. The 30-minute and 60-minute basis on Tesla during the day and during the week can provide opportunity to short. I don't like shorting after you see shit like this. Like, so when it breaks up above a range, I don't like to short that because it could work, it could not work. Most often, it doesn't work. Most often, it sets you up for failure. So I don't like to short things like that personally. But should the 5-day ever break, you've got a really wide range between the 5 and the 20-day. So if you see a breakdown, you can create an alert. So for me, I'll create an alert here. If I see a breakdown of this 5-day, it will really set up for an opportunity to test this 20-day. And that's kind of how I'd look at it from the perspective of how I can short it. Outside of that, you set up for an opportunity for a retest of this 50-day, which just so happens to coincide with its breakout level. So an easy way to trade it, if you're looking like, oh man, I missed the move, I really don't want to miss the next move if I ever get it, highlight your 50-day, highlight your 100-day, highlight your 200-day. If you are one of these aggressive people, this is not a recommendation. This is not an opinion for what you should do with your money. But one way that I would look at it is I would look to sell options at this 600 level or at this 1,000 level. The reason that I look for that is because if I miss the whole move, I don't want to chase it here. And with it being where it is, and when I say I don't want to chase it here, I mean I don't want to chase it to own it. And with it being where it is, with premium being elevated the way that it's elevated on options, I can get a nice little buoy that I can own the stock into should it test its 200-day. If there's one thing that Tesla has shown you in the last 5 to 7 years is that a lot of these moves that happen to the upside shouldn't be chased because you will have opportunities when it comes back down. You just had one between February and April where the stock created a new high on a serious ramp. So it started on this gap way in October where it was trading at 294, ran all the way to 1,000, came back to this 300 level that it broke out of, and then it's been up and away ever since. So you can target with probably a high probability this $1,000 level. Then again, you can target this 200-day moving average. So if you've missed it, don't panic, don't buy it. I've gotten a lot of questions from people. What do you do when you miss a stock? What do you do when you miss it? The answer that I will give is the following. What do you do when you ask someone out and they say no? Do you panic and blow up their phone 50 times? Do you text them why they made a mistake? Do you panic and go cry? Like, what do you do? Most people don't do those things. Most people go, okay, that person didn't say yes. The next one might. Maybe I'll ask them down the line. Maybe they'll change their mind. So just think of it the same way. Like, you missed your opportunity to ask Tesla out. She's with somebody. Give it some time. Try again at a later date. Try again when things aren't as pristine for this person. So in terms of Tesla, if you've missed the run, and again, last week in the video, you can go back and you can watch the video that I had last week. I didn't have any Tesla going into last week. I had my personal best day in 3 years, I think, on Friday. And I had no idea that was going to happen. Like, I didn't go into last week telling you that Tesla's it's going to absolutely create new highs. No, I told you that it sets up for a potential like the one it had here in February, where it could sell off. And if it doesn't, I stated, if it doesn't, and if it holds this 5-day, it sets up for a squeeze. So just look at it from that perspective, and things should be smoother and they should be a little bit clearer. You could wait. It could go sideways and it could break out again. You could try it for a long again. I'm not saying to short it. I'm not saying to buy it. I'm not telling you what to do with your money. I'm just telling you that this is an opportunity. This is a stock that creates several opportunities, and chasing it on any valuation or any idea, like even on the most absolutely insane diehard Tesla fans will tell you that, hey, let's pump the brakes a little bit. Let's not chase it here. Even Elon will tell you. He told you a few months ago the stock was too high, and ever since he told you that, the stock's only gone higher. So, we'll see how it performs. But for me, this is not a scenario where I look to chase things. You will have opportunities in this market, and if you love Tesla and if you like Tesla, an opportunity that's setting up that I'm finding is in Virgin. So this is setting up to be a very similar story to that Tesla narrative story. It's setting up an opportunity with heavy short interest, decent balance sheet, and no other way to play the space. So, no pun intended. So, no other way to play space travel, space stocks, etc. Unless you're playing Tesla as a derivative with SpaceX, right? So, with that being said, acted very, very, very well, held its 200-day, has a confluence of moving averages below here, and is flagging above its 5-day and all these moving averages. If it's able to get above this $20 mark, this $21 mark, look the fuck out. So this is one that I added last week, I highlighted last week, and I own, and I will continue to own, just as a lottery ticket, if not anything else. So if you've missed the Tesla run, and if you've missed the opportunity in Tesla, you want to highlight the same things that Tesla had prior to it ramping, and you want to find similar opportunities. So last year, it was Beyond Meat. If I can type, it was Beyond Meat. Beyond gave you an opportunity because Beyond, there was no other way to play that space, right? And there's still really no other way to play that space in the public market. So with that said, you can highlight a stock like Space. It's an opportunity. It's in an industry that doesn't really have any other opportunities. And it's a stock that has heavy short interest. Last I checked, it was about 24%. So this is an opportunity. I'm leaving it there. It's been an hour. Thank you for tuning in. Thank you for watching. Thank you for listening. Please, please, please leave your comments below in the comments section. Please share this video if you find it helpful. Please leave me a comment below in the comment section if you find it helpful. Please like this video. Please subscribe to this channel, whether it's the podcast or whether it's the video. Please, all of your feedback is appreciated. If there are things that you want covered, please at me at everytimeicash or everytimeicash.com/contact. You can also reach out to me on all social media at everytimeicash. I'm going to be experimenting with new delivery mechanisms, shorter videos, bite-sized videos, etc. For now, I'm doing these long-winded, long-form podcast videos just to see if they are helpful. So please, please, please share them, like them, comment in the comment sections. Let me know what you liked. Let me know what you don't like. And you can reach out to me at everytimeicash or everytimeicash.com/contact. Stay safe, stay profitable. Stay safe, stay profitable. And until next time, stay locked in.